Rohit Agarwal, Fund Manager Equity, Kotak Mahindra Life Insurance joins us right here on the channel. Rohit, hi, good afternoon. What is your view on the IT space, especially the blue chip companies? We saw good numbers coming in from TCS, Infocyis, however, disappointed. Wipro lined up for tomorrow. What are you expecting the overall performance to be like for for the entire year, FY19, and especially Q4?
Hi, good afternoon. Well, as you said, we saw two of the biggest IT companies reporting yesterday, and actually the results were pretty divergent from each other. Our outlook on IT for next year or for a longer term horizon is it is no longer probably a sunrise sector, but it is a sector which is likely to grow at anywhere between 7 to 10%, give or take. And the earnings growth should be pretty similar unless there is a steep appreciation or depreciation of the currency. If you keep in mind what's happened to their margins over the years, actually currency doesn't help, and we believe it's a myth, because currency has moved from 40 to about 70. Their margins are down anywhere between 500 basis points to 1000 basis points. So barring the quarterly blips and the analysts who keep writing reams of sheets on how currency impacts margins, we don't believe anything of that sort happens. But what will keep the stocks in a range is probably the kind of buybacks that most of these companies have resorted to, which is rewarding their shareholders. If you saw the companies that reported yesterday, both of them are actually paying out more than 90% of the cash that they generate throughout the year. Now, when the companies continue to do that over longer term, you add 2 to 3% of dividend yields, then there is a downside protection unless, of course, something goes wrong macro-wise. But the sector as a whole, we don't believe it's a sunrise sector. It's more likely to be at max just touching double digits, more likely less. It's like 5 to 8, maybe 7 to 9 in a good year. So it's not a sunrise sector. It will be a defensive sector, a good free cash generating sector. And at times where you believe that the Indian macro is deteriorating, I think it can be a good place to hide, but it is not a sector that we believe will give outsized returns over longer term.
All right. I was just reading your views, a couple of pointers. You say that Q4 to miss expectations slightly. Now, which are the sectors you think could disappoint?
Well, we believe that some of the consumer and the auto names are likely to disappoint on margins, and you would probably also likely see or hear their commentary getting into the first 6 months of the year being weak, even if not for 6 months, certainly for the quarter, where they will likely call out for challenges related either to elections, either because of lack of funding, or due to a general slowdown. Well, it's a reality that farm incomes have not gone up as much as everyone had hoped or envisaged. Given that situation, it is unlikely that rural India continues to be as buoyant as it was in the past. So you are already seeing some kind of a slowdown. It's evident currently in staples, but if it continues, you will start it getting permeating to maybe discretionary and some of the other segments as well. So I think the auto and the consumer pack is where you are likely to see disappointments in volume as well as margins.
Okay. Just help me understand, would it be wrong if I say that you're not comfortable even with the valuations, given how most sectors have seen a consolidation, given how you are looking at consumption space, that even going forward there may not be a very impressive or a promising earnings growth? How are you looking at the valuations at this point in time?
Well, the consumer sector, the valuations we believe are pretty stretched right now. They have had a dream run, a bull run of sorts in the last 5-6 years. Now, most of the staple sectors is anywhere between 45 to 55 times 1 year forward earnings. Now, the earnings may not materially slow down, but I think an earnings CAGR moving from a 13-14% to a 10-12% is enough to change the multiple that you give at 45-50 to 35-40. When that happens, either the stocks will stagnate for some time or they will fall in absolute terms. So that's the call. We don't believe that consumer sector will start degrowing in profits. We just believe that the time has come where it either takes a breather in terms of time correction, which happens through cycles from time to time, or they correct in absolute terms of say 5 to 20%, depending upon which stock or which particular sector you're looking at.
Rohit, pleasure chatting with you. Thank you so much for coming on board and giving us your insights.